So we want to thank you again for tuning in to our Retirement Education Center channel. We're going to continue our series, Andrew, on 12 steps to retirement income sobriety, if you will. This is going to be part 3 of our 4-part series on 12 steps to retirement income. And so you're going to definitely want to stay locked in, as we're going to give you today 3 more critical steps that you're going to want to take in order to have a really strong retirement income that you can depend on. So stay locked in. Hi, my name is Carson Graves, President and CEO of the Retirement Education Center.
And my name is Andrea Graves, Director of Operations at the Retirement Education Center. We want to thank you for tuning in to our Retirement Concepts videos. These videos were created to make the difficult and confusing retirement process simple.
Absolutely, Andrew, because with so many retirement concepts out there, and of course with so many retirement strategies and so many retirement products, it can become very difficult for consumers to have to digest it all. So we are so thankful that we work with a team of expert advisors that can help us build a financial roadmap that will let our clients know when, where, and how they can reach their retirement goals.
For additional concepts on how to maximize your retirement income, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos. So Carson, this 12-step retirement income series is to make sure that retirees can maintain their dignity throughout their retirement years.
You know what, Andrew? I really couldn't have said it better myself. Absolutely, that's what this series is for. Now, it's like any 12-step series or any series that you may do, right? Now, some people can maybe only do 1 step, some can do 5, some can do all 12. You know, it just depends on where you are in your retirement growth, right? Everybody has retirement maturity or savings maturity, and so it depends on where you are. But the main step to doing anything and trying to accomplish that goal is to start somewhere. And when you start somewhere, make sure that you can consume that first step or that second or third, whatever step it may be. Make sure that you can consume that step completely before honestly moving on to the next step, because that's really what the overall goal should be. To think about each step individually, not as a whole program, but try to get over the first step so you can be equipped to get to the second, third, fourth, and so forth. And so, of course, today we're going to continue this series and giving you 3 more critical steps that you may want to think about in building that retirement income plan. And before we do that, there are still 2 rules that we must give you for retirement income. And Andrew, what are those 2 rules?
Well, rule number 1 is to never run out of money, and rule number 2 is to never forget rule number 1.
All right, so let's go ahead and dive into part 3 of trying to sober up a retirement income.
All right, Carson, so step 7 is to know thyself. What does that mean? Yeah,
what does that mean? I don't know what that means, but I can tell you what I think it means. One of the things when it comes to this step of your retirement income planning, Andrew, is that you're going to want to know how much your retirement is going to cost you. Retirement can be very expensive, and by most analysis, people say that you're going to need at least 70 to 90% of your pre-retirement income to retire comfortably, right? We've talked about that, and we know that number can be obtained, but it's going to take careful planning to do so. So you really have to start saving towards that goal. You have to know what your retirement income goal would be first in order for you to start trying to figure out how you're going to get there. So if you're already saving, well, I say kudos to you, keep going. And if you have not started saving, then you need to start right away. It's really never too late, it's never too soon to start, but you have to start somewhere. What I always tell my clients, or anyone, no matter what endeavor you're going into, it is never a bad time to make a good decision. I'll repeat that. It is never a bad time to make a good decision. So when it comes to knowing yourself, you need to know what is your retirement going to cost you. How much income will you need? What are your expenses? Once you map out these things, then you can go ahead and start aggressively saving into your company's retirement plan. If you have a 401k, a 403b, 457, start aggressively saving there, because you can have free money that's offered to you from a company's match. And then outside of that, you can start aggressively funding other retirement accounts like IRAs, Roth IRAs, traditional IRAs, or even non-qualified accounts, brokerage accounts. that sort of thing. So we can help you scope out a plan for your retirement income goals once we figure out how much income you're going to need to retire comfortably.
All right, step 8 is to minimize taxes.
Yes.
Now, is that easier said than done?
Well, it depends, Andrew. If you're working with a competent fiduciary financial advisor, it can actually be easier done than actually said. So you have to make sure you know who you're working with. And so we've been working with clients on these matters for, like, as you know, for more than 2 decades now. And so we absolutely have the tools in place to help clients to understand how they may go about minimizing taxes for their retirement income. One of the key things that you're going to want to have to think about is having tax diversification when it comes to your retirement savings. Now, we always want clients to have 3 types of retirement savings. And let's just start with your brokerage account. Now, with your brokerage account, this is going to be money that you're not saving in a tax deferred account like in an IRA or your 401k. The brokerage account is going to be money that's already been taxable. So with this being the case, the money inside of this brokerage account is going to be exposed to having interest and dividends and capital gains. And so when you have dividends and capital gains, you're going to get a favorable tax treatment. It can be anywhere on the low end to 0% on the income generated from that brokerage account. And the highest tax rate on the capital gains or dividends from those accounts can be 20%. Most people pay somewhere in between. But just understand, you're already going to have a tax break by having a different type of income source coming from a brokerage account. Next to that, I'm going to talk about your tax deferred accounts, your traditional IRAs or your 401ks, your company accounts that you're deferring your income into on a pre-tax basis. Well, right here, you're obviously going to be minimizing your taxes, Andrew, because the money that you put into your 401k is going to be completely written off from your income. So we've talked about this numerous times. So you always want to be able to take advantage of those types of situations, especially if you're someone who may be a high income wage earner. You can absolutely benefit from having, that income being reduced by the money that you're putting away into your tax deferred account. When you retire, you could perhaps be in a lower tax bracket. So that income comes out, it's going to be 100% taxable at your ordinary income. But what if you're actually in a lower taxable situation at that time? But you don't know, so that's why diversification is going to be proper. But last but not least, if you can, and everybody can fund a Roth IRA, some can fund it through contributions, some may have to fund it through Roth conversions, but nevertheless, everyone at this present day can actually contribute in some form or fashion into a Roth IRA. Now, if you're able to do that, that money is also after-tax dollars. But that money inside of the Roth IRA, unlike your brokerage account, can grow tax deferred, and that money that comes out of that Roth IRA is tax-free. So if you're able to construct a retirement, income plan around these 3 unique, taxable accounts or tax-free accounts, then you are absolutely in a position to where you can minimize your taxable income during retirement.
All right, now Carson, step 9 is to manage your pension. Now, everyone doesn't have a pension, so I'm assuming this is for the lucky people.
Yeah, this is for the lucky people, the people who may be fortunate enough to have a pension. Now, we talk about pensions a lot on our channel because we know that we have a lot of of our clients that receive pensions, maybe from the military, maybe from if they're a teacher or they work for a government entity, they're going to get a pension. But we know that we have now approximately 14%, only 14% of Fortune 500 companies now offering pensions to their employees. So that's critical. But if you're getting a pension, it is very important that you understand the options that you may have with that pension. Now, you may have the opportunity within your company's pension to roll that pension over as a lump sum value. Or of course you can take the pension income, and there's going to be options with that as well that you're going to have to be very, very aware of, because you can make a mistake and you can't reverse that mistake. Now, if you want to take the lump sum option, you're absolutely going to want to talk with a financial advisor. We help our clients with these analysis all the time, Andrea, to decide if it's a lump sum option is going to be beneficial for you. Now, you take that lump sum option, you're going to free yourself up with those pension dollars. Now, you may feel like you can manage those funds better, or perhaps pay someone to help you manage it better. And perhaps you have enough resources and confidence in having those dollars outside of that pension to where it can grow faster against inflation than maybe what the pension would be doing. So you have to be confident in your approach when you're doing a lump sum payout from that pension. And of course, you're going to be giving up the opportunity of the lifetime income payout that pension is going to offer you. And that is okay. That can be solved too. You know, you can literally roll over that pension into an annuity, or at least some of it. You know, you can manage your money in that fashion as well. If you do that, you still will have the opportunity, of course, to generate lifetime income from the annuity. There is one big exception to that versus the pension and getting that income. When you roll that money out of that pension into an annuity and receive that lifetime income, if you were to pass away, the assets inside of that annuity will go to your beneficiaries in kind. So that's really, really important to understand. You know, you don't. If you leave that money inside of that pension, the only thing that can transfer out to your spouse would be the income itself, not all the money that pension may be worth for your estate. So the other thing, obviously, is that you could have the lifetime income. You're going to have choices with that pension lifetime income as well. You can do single payout, or you can do a joint payout with 100% survivorship. Now, I've seen clients check the wrong box, and we always tell them, do not fill anything out without, showing it to us first, so we can help you march down that road and not have that mistake, and also have your spouse maybe looking at you in a very, very nefarious way as you're, lying upright, or vertical, however you want to, horizontal, whichever way you're going to be lying. You don't want your spouse looking at you in a very nefarious way, because they realize that your pension is actually stopped upon your passing. So you want to make sure that you check the right boxes when it comes to your pension, and not think about the highest income, but think about the most effective strategy for your household. But this step here, Andrea, if you're lucky enough to have a pension, you must make sure that you're reaching out to a qualified financial advisor who can help you navigate that pension option that you're going to have.
All right, Carson, thank you again for your insight on that topic, and thank you for watching. And if this information was beneficial for you, we ask that you please like and share this video with others.
So I really hope that the third part of our 12-step series, is giving you some insight on how you can have a more sober income. Please understand that these videos are created for educational purposes only, and you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. And if you're looking for a fiduciary financial advisor to help you with these type of complex financial matters in an unbiased way, independently, we highly encourage you to click on the links in the description below and go ahead and schedule a 1-hour consultation with us today.
For more information about this topic or any of the other topics that we've shared in our other videos, please feel free to reach out to our office or leave any comments or questions in the section below. After this video, please check out our other videos that we've created that will give you tips on how to maximize your retirement. And if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers.